right, welcome everybody. We'll give us a minute or so for everybody else to log in.
Hey, Jonathan, you got a nice office up there.
Thanks. Yeah, it's my virtual office. Thanks, Derv. It's my virtual office.
I see.
Yeah, it works.
All right, so for today's lunchline, we're going to cover what banks look for in an application. Jonathan?
Yes. Okay, here we go. Let me share my screen here. Oh, 1 second. Okay, hi everybody. So today we're going to talk about what lenders look for in a loan application. They're pretty basic, pretty extensive as well. So these are the 5 main qualifying factors lenders take a look into: credit, employment history, and assets. I hear a little bit of, zing in my speaker. Am I coming across pretty clear to you guys? Hello?
Hey, you're coming in clear.
Am I coming in clear?
Yeah, I can hear you, and we are all muted on our end.
All right, great. Just making sure. All right, so let's start with credit. These are the ranges of credit scores. 850 being the highest, excellent, all the way down to 550 being poor. Now we do have loan programs for these credit scores, but then again, they all vary. It could be government loans for the lowest scores, and then conventional rates for conventional loans for the higher scores. This is how, hold on a second, just slideshow. Yeah, hold on a second, here we go. Okay. This is how your credit scores get graded. 35% of your payment history weighs heavily into establishing your credit score. And after that, 30% is the amounts owed on your credit score, on your credit accounts. So meaning if you have
Hey, Jonathan, for your presentation, you want to share your screen?
Oh, okay. You don't see the screen? 1 second. Let me just click out of here. Go to Zoom, share screen.
Between 5 and 6 apps. The choice is yours. It all depends on your preference and lifestyle.
Okay. There we go. Can you
Perfect.
see?
Now we see it.
Okay, sorry about that, guys. All right. So 5 qualifying factors: credit, employment, income, property, and assets. Okay. Let's start with the credit. This is how credit scores look like. 850 being the best, 550 being the lowest. Anything below 550, no loan program for that. FHA is your safety net for the lower scores in here. Now, this is how the scores get graded. Payment history accounts for 35% of weight that they put into establishing your score. And then the amounts owed per credit card is the next biggest factor. So that means, let's say if you have $1,000 credit limit, you don't want to go above 30% of whatever the balance is of that credit limit. Anytime it goes above 30%, it starts chipping away from your credit score and starts lowering your score. So, you'd like to advise your clients to stay within the 30% or lower balance based on your credit limit. Of course, length of credit is also a biggest factor, a good factor in that one. Do not close credit cards, because the minute you close credit cards, again, that takes away from your credit score. So if they don't want to use that credit card anymore, just snip it, throw it, don't use it, but keep it on there. Now, there are some clients that say they don't want to pay the yearly fee. Fine, as long as they're not in the middle of a loan process, go ahead, close that account. But then again, don't keep closing accounts, as often as you open them. New credit accounts for 10%, of course, and then types of credit used. So if you have an installment loan, usually that doesn't weigh into heavily in your credit score. But the revolving debts, like the credit cards, these are the ones that actually are very credit, sensitive in affecting your credit scores. Okay. Any questions here? None. All right. How credit score affects the rates? As you can see, 740 and up, if you're going FHA, rates are at about 2.875. Now, as of yesterday, the rates went up, just maybe by about a quarter. But in today's market, everybody out, which shouldn't really, because we're still at the lowest. Even if it goes at 3.5, we're still pretty good. All right, but let's say, for instance, 740 and up, you're looking at FHA 2.875, conventional being at 2.99. 700 to 739, same rate for FHA, bumps a bit up for conventional. So you could see that the pricing for conventional is pretty sensitive depending on the credit score. Fannie Mae, Freddie Mac, which are conventional loans, cap out at gives a minimum credit score of 620. Anything below that, does not qualify you for a conventional loan. Next step is to go either FHA, or if you're a veteran, you're still good below 625. All right. Now, when you have a bankruptcy, this is based on the matrix of conventional loans. So if your client had a bankruptcy and a discharge, conventional loans require 4-year seasoning after the discharge date. Now, depending on the circumstances around filing the bankruptcy, that's called extenuating circumstances. If it was a valid extenuating circumstance, act of God, got into an accident, you were disabled for quite a while, affected your finances, then they may lower that to 2 years. If you have a BK13, same thing. 4 years from dismissal date or 2 years from discharge. Now, I've faced this dismissal date before. And you know what? Even with a dismissal date, you still do need a discharge because your accounts could still be open and these bad accounts could still be affecting your credit score. So when you do file for a Chapter 13, or if you have any clients that you know of that have a Chapter 13, make sure that they conclude it by filing a discharge as well, because that will definitely affect the loan and the qualification. Now, if they have a foreclosure under the name, it's going to be 7 years before they can qualify for a conventional loan from the date of sale of that foreclosure. 3 years with extenuating circumstance. Now, FHA and VA loans, they're a lot more forgiving. As you can see here in the matrix, FHA only requires 3 years seasoning from date of foreclosure or 2 years seasoning from date of discharge for the bankruptcy. Same thing with VA. VA foreclosure or deed in lieu, actually 1 year less than FHA, 2 years. So they're a little bit more forgiving in terms of seasoning dates. Assets. Now, acceptable funds to close or origination of funds should come from your savings meaning checking account, your 401ks, these type of liquid assets, or can come from a gift, or if you've sold some assets, sale of assets. And of course, you've got to document these things. So that's just the source of funds that is acceptable for the bank for you to provide. They're not going to accept cash, or if you have cash stuck away, in your safe at home, and then all of a sudden you deposit into your bank. There's no seasoning of that deposit because there's no paper trail or source of funds. It's purely cash. They're not going to count that. So if you make a $50,000 deposit and you show that in your account because you don't have 2 months seasoning on that, that's not going to be counted and can't be accepted by the bank. Okay. Employment history. Now, the bank requires that you have at least a 2-year history with your employer. Or if you change employers and you may not have the same position as the previous job, at least you're in the same industry. Now, if you just graduated from college, say you got an engineering degree medical degree, RN, any of those type of jobs, as long as you have your transcripts, your diploma to show, that's considered continuation, and that would be considered even if you have 1 month in your current employment coming right out of college. That's okay. And as far as being self-employed, they want to see a 2-year seasoning as well as a self-employed independent contractor or a business owner. Let's say, for instance, if you came from payroll as a wage earner, still working with the same company, and then they switch your status from being a wage earner to an independent contractor, that totally resets your job seasoning, because now you're going to have to wait 2 years to qualify as an independent contractor and season out that status. So some employees may request their employer to get them back into the payroll, and if that's at all possible with the company, then that's great. But if not, you're just going to have to wait to season it out. Now, some borrowers may have 2 jobs. It's important that the second job is also seasoned for 2 years. Because if they have a first job that's seasoned for 2 years and then just got a second job and expect that second job to help qualify them for the loan, the bank's going to look for a history of at least 2 years on a second job. And if they don't have that second job history, then we can't count that income for the second job. Okay. They also ask questions. Let's say, for instance, if they get their base plus overtime. Now, overtime will only be considered if they can prove that they've been having overtime for the last 2 years. How's that done? Through verification of employment. Or to speed things up, what I do is I ask the borrower to give me their last pay stub for last year, and then I got their current pay stub, and I can show at least the year to date that they did have their base and that they did have the year to date overtime. That way we could count their overtime in as well and just average it out, from year to date to last year's performance. And sometimes we even have to go the previous year after last. So 2021 year to date will show when the current pay stubs, and then we have to ask for the last pay stub of 2020 and the last pay stub for 2019, just to establish overtime, if we do need that overtime. If we don't need that overtime, that's okay. We don't have to go through that. Now, what about a borrower that has disability? I have this one case right now wherein she's got 2 jobs. She's got her main job and then her part-time job. However, she got into disability, paid disability, in April of 2019. And she was on disability all the way up to April of this year. Now, what happens there is that the main job will be considered the minute she gets back back to work from a disability that long. Main job was considered. However, her part-time job, she will need to season that part-time job for 12 months in order for that income to be considered. Okay. So these are like special case to case, if in case you have a borrower that got into disability. Any questions so far? Any special cases you guys may have regarding this? If not, we're moving on. Now, documentation. Just to give an example of what we need for a typical FHA, VA, Fannie Mae, Freddie Mac loan. Fannie Mae, Freddie Mac, conventional loans, okay? W-2 forms and federal tax returns, always the last 2 years that we need, last 2 years income, proof of income. Paycheck stubs, last 2 pay stubs if they're paid twice a month, or last 4 if they're paid weekly. Bank statements, last 2 months, whether they're last 2 months, last 2 quarters, last 2 statements, semi-annual, or last 2 annual statements. So if they have a bank statement that comes in once a year, we need the last 2 years. If it comes in every 6 months, last 6 months, last 2 semesters. The thing is, we do need complete pages. And a lot of the time, not always, but I think a little bit more than often, when we do ask for complete pages of bank statements, we're always given the first or second page, or they forgot to make a copy of the back page. and we just get page 1, 3, and 5. When the bank asks for complete pages, even if the last page is blank, we do need that. So if you see page 1 of 8, we need page 1, 2, 3, 4, 5, all the way through page 8, even if it's blank. I can't stress that enough. I do get a lot of complaints. Why do you need, the last page if it's blank, blah, blah, blah. Well, believe it or not, we just can't close your loan if you don't give us that last page. It's ridiculous. We should have more common sense with underwriting, but unfortunately, that's black and white guidelines that we have to follow. And so we just have to meet that. So just go through a little bit of effort to get that last page. That would be great. And I do help the clients, I do help assist them in getting that. Very patiently, of course. Okay. 401k, we discussed that. Driver's license, a must, submit. If we're going FH or VA, they need the social security card. With VA loans, you may not be familiar with the DD-214, but that's a discharge paper from the Army. So it shows whether they've been discharged with they had an honorable discharge or otherwise not. And then certificate of eligibility. This one we have a portal we go into as a lender, and we could pull that out if we have problems, and we reach out to the borrower, VA borrower. Now, if the borrower is divorced, it's important to get the final divorce decree, not the filing, not a petition, but the final recorded divorce decree. It's public record. It could be taken out of the archives. From the archives. I know there are services, maybe title may be able to get that service done. I know for a fact that back in the day, I had to go to the LA archives just to pull out, the full final divorce decree for some of my clients. Not anymore, thankfully, because people tend to be much better in terms of filing their records on their e-file on the computer, or are able to go to a certain website, I think, to pull that out. If they are receiving alimony or child support, we would need a copy of that court order to confirm that income. On top of that, proof that they've been receiving that income for the last 12 months. So usually it's providing 12 months of consecutive bank statements, again, full and complete pages, to prove that child support income. If they are receiving Social Security or retirement income, we do need a copy of an updated award letter. Now, with Social Security, especially retirement income as well, when we say updated, if it's the year 2021, there should be an updated letter that has been mailed to the borrowers. With Social Security, it's easy to get that on the website in case they don't have a copy. Retirement income, it usually comes in, but if not, they should have one where they could call, a letter in the past where they could call the number and request for an updated copy of their retirement award letter income. Okay. If the borrower owns properties, copy of the latest mortgage statements for all properties owned, updated homeowners insurance. Again, I want to stress updated. Half the time, I'm being provided homeowner insurance that has expired. And unfortunately, I think a pretty good chunk of people out there don't really pay attention to keeping those updated in their records. But it's easy to get. You could always call your insurance provider, ask them for an updated insurance, and they'll provide that to them. And a copy of their last property tax statement for all properties. When I say last property tax statement, I mean year 2020 to year 2021, not 2019 to 20 or 2018 to 2019. It's got to be the last and latest property tax statement, because they'd like to see, if taxes are still pretty current, and no collections in there, and the updated property tax that they're paying. If they have properties rented, they will have to provide copies of the rental agreements, and of course tax returns, because we take a look at the Schedule E to compute their net rentals. Okay. If they had a bankruptcy, copy of the discharge letter and complete BK schedules, which are about this thick sometimes. A lot of the times, over time, they tend to misplace the bankruptcy schedules, but that's very important because the underwriters, they will reconcile their credit report versus the bankruptcy schedules to make sure those accounts match. And of course, the discharge to confirm that it's done and over with. Now, if they're self-employed, and copy of the tax returns. It's just the federal tax returns that we're looking for. We don't look for the state tax returns. But if it's in the same attachment, why not? We'll get what they have. For self-employed, they do need the signed year-to-date profit and loss statement. Usually can be provided by their accountant, bookkeeper, or whoever helps them out with their accounting. Copy of the corporate federal tax returns if they're incorporated, LLC, S Corp, C Corp, last 2 years of the business tax returns. Only if they have 25% or more ownership of the company, which most of the time they do. If it's a partnership, then the Form 1065, this gets pretty technical in the forms, but this is a list of items that I do provide to the clients so that they're guided. Now, if they've sold a home in the last 12 months, that's definitely a copy of the final closing statement of that transaction. Okay. Next, income. Of course, how do we get approved? Is with the income is the debt to income ratio. So, what they're going to do is they're going to get their future principal, interest, taxes, insurance divided by their income. If they're employed, then it's gross income. If they're self-employed, then it's divided by their net income. And it should not exceed 46.9%. That's what we call the top ratio. Okay. The bottom ratio is their future PITI plus their monthly debts divided by their income, should not exceed 49.9% for conventional loans. And we could go all the way up to 54.9% for FHA. Now with VA, we could go way above that, depending again on each case. Property. The bank will look at the property evaluation through the appraisal report. There, they'll be able to see the condition of the property. Now, sometimes some appraisers may not condition for repairs, but if there's anything showing on the picture that may trigger a concern for the underwriter has the discretion to ask for a copy of the home inspection report, to see what's on there. I've had a file which was a conventional loan. We didn't expect any repair conditions there. The appraiser did not give any repair conditions. But because there was so much leaves on the roof of that property, and there looked like there was a bit of rotting, I think, on the side, on the eaves, then the underwriter did condition for a copy of the inspection report. And after reading the inspection report, she did find a few things that had to be repaired. And so that's what we thought. It felt like an FHA loan right there, but they do condition for that. Another instance wherein it was a conventional loan, everything looked good in the property. However, on the patio, they had a steep drop. It was almost like a ravine, but it was all their property. And because of that, the underwriter required that the property, that they put a fence on the edge of their patio, which is for safety. So when it comes to safety issues, they're pretty much strict about that. Pool, swimming pool. If the water is not that clear, they could condition for the swimming pool to be drained and and filled up with clean water. And a pool always has to be full, because if a pool isn't filled up, again, that's an issue. It's a safety issue, and they're not going to fund on the loan unless the pool is filled with water. Okay. The programs and rates can also depend on the loan to value of the transaction. So loan to value is the loan amount over the value of the property. So if it's a 95% loan to value, then the higher the credit score, the better it is for the PMI factor for the borrowers, the lower the PMI. The lower the credit score, the higher the PMI. So it does affect their monthly payments. Any questions so far? Okay. Sources of mortgages. Primarily about three sources. We have the government loan, which is FHA and VA loans. And then we have the conventional, which is Fannie Mae and Freddie Mac loans. And then the private money, jumbo, hard money, and as you've heard the term before, non-QM. So let's go with government loans, FHA. FHA is a Federal Housing Administration loan. It's federally backed mortgage designed for homeowners who may have lower than average credit scores. Usually we go to an FHA loan if your buyer does not have more than 3.5% to put down, number one. Or number two, they're credit challenged, which means maybe their credit scores are 620 or below. And thirdly, if their debt to income ratios exceed 50%, conventional is not going to accept anything above 49.99%. So the next best thing is FHA. Those are the main reasons why you want to go FHA. Now, when you're going FHA and buying a condo, you'd like to make sure that that condo complex is FHA approved. And there's a HUD website that we go and check to see if the complex is FHA approved. So if you're looking to condos, you wouldn't know whether it's FHA approved or not, reach out to me, let me know. I could send you that link. If you want me to look it up for you, I need the name of the complex. It's very important, and the full address, of course. And then we'll be able to look it up to see whether it's FHA approved or not, okay? Another one, I just got a loan, which was a fallout from B of A, wherein the condo cert showed, because anytime you do a condo, you have to send out the condo certification to the HOA or the management company for them to fill out. When it came back, it showed that 59% of the units in that complex is tenant occupied. That means you've got more investor-owned properties in the complex than you do have owner or primary residence in there. That was thrown out by B of A. They weren't able to do the loan. With us, we're able to accept that. We could even go up to 99% of non-owner occupancy in the condo complex, and we could move ahead with FHA on that one. All right, so that's not an issue for us. Okay. Anything more about FHA you guys might have any questions about? Nope. Okay, moving on.
You want to mention the 203K?
Oh yeah, okay. So we also do have, thanks for reminding me that. We do have the 203K, which is under the FHA. So if your borrower is looking at a house that may not really be in tip-top conditions, because FHA does require the home to be in good condition before occupancy. But if there is a home in there they're looking at that might need some fixing, holes on the walls, cracked windows, exposed wirings, we do have a loan under the FHA, which is called 203K. They could still put 3.5% down, and the bank will give them an additional $30,000 to fix up the property, and you could occupy the property while the work's being done. You're given 6 months to do that. The inspector is going to come in at least once or twice to inspect the work is being done, and then final inspection. With that type of loan, you do need a qualified and good and licensed contractor whose license is in good standing. We would have to request for an estimate from the contractor for labor and materials on whatever has to be done on the property. There are a few more steps to be done with a 203K loan, because there are additional disclosures that will have to be signed. The contractor will have to provide their liability insurance and workman's comp insurance as well, and then everything is up to date. So it takes a little bit longer to close a 203K than your regular FHA loan, maybe about 15 to 30 days longer, depending again on how fast you can get your work over to us. The rates on 203K are usually going to be about 0.5% to 0.75% higher. But then after the whole work is done, we could always streamline your loan into an FHA regular rate if the rates are pretty ideal at that time as well. So yeah, we do have that available to you. So And usually sellers would like to sell to occupying borrowers because they're not going to get lowballed as low as investors that want to buy the property. Although with investors, they pay cash. Depends how desperate the sellers want to sell. But if the seller, has the time to wait and would like to get top dollar for his property, 203K borrower would be a pretty attractive borrower to consider. Okay. Any questions about 203K? All right. Well, VA, of course, that helps the veteran. Zero down. We no longer have a loan limit in VA. We could go as high as 2 million.
Hey, Jonathan, if I can interrupt you for a sec here. Can you hear me all right?
Yeah, absolutely.
Okay. Danny's mic wasn't working there for a minute. So when he bought his first place, as you know, he got that 203K.
Yes.
So that enabled him to go in and do a lot of work. Did you get, was it 20,000 extra or 30,000?
25,000.
20, yeah, he got 25,000 extra.
I remember
So yeah, I know it's going to be difficult in this market because everything is kind of as is, and they want simplified contracts, purchase agreements to get yours accepted. But that is an option that will be coming back at some point. So that 203K, and then when you're done, I want to tell a story about that 2-year escrow we had.
Yeah, that was a fun transaction. Yeah, but right now, yeah, realistically, it's really hard to get in there with a 203K loan because everybody is just paying way above and beyond what the asking price is for. So it's there's still a frenzy going on there. Although yesterday we did have experience a bump in the rate. The Fed said they were going to start increasing the rate, so that caused some panic in the marketplace. And instead of having a 0.25% bump, it went even, some lenders as high as 0.5 point. So we'll see where the rates go. But like Ray, I forgot the financial guy, Ray, in the last meeting said, you know what, rates are not going to go anywhere for the next 20 years anyway. Well, let's see what happens. Now, with the VA loan, rates are very, very good for VA right now. I've posted a deal for one of your agent's sons, Chris Mullis. Was able to get him a 2.375% 30 years fixed rate at 0 points for a VA loan. You can't get that kind of rate for FHA or conventional. So I had another guy that did a 2-unit property. We were able to get that done for him also. So VA loans are very good loans for the vets. The only thing about VA is that they're very, very strict with the condition of the property. Regardless, no termite waiver is allowed with VA. So immediately they're going to ask for a termite report and, if necessary, a termite completion on the VA loan. No ifs, buts, or whats. Unlike FHA, you could have a termite waiver. Then we ask you just don't submit to us a termite report. We're not going to bother with that because on the contract you can see there's a termite waiver anyway. So we're okay with that with FHA, unless the inspector or the appraiser rather does see evidence of infestation, and he's going to call that out on the appraisal, and now you're going to have to do a termite completion on that. But if that's not evident, what he sees is what shows on his appraisal report. VA loans pretty easy. They're very forgiving in terms of debt to income ratios. I've had one go as high as about 58. I've heard of another associate close one at 65% debt to income ratio. So, we don't totally disregard the VA with those high ratios. We run it through the DU, and VA is definitely going to approve. And whatever the DU, meaning direct underwriting system, whatever they approve, the bank will honor. Okay? So that's with VA. Any questions about VA? Okay. Conventional loans. Conventional loans.
Yes, Jonathan. For the VA, I know a lot of people write offers with a deposit. So how do they handle that since it's no money down?
Well, that deposit goes either to part or all the closing costs, because with VA, they still collect at least 6 months worth of your property tax as your reserves, a full year of premium for your fire insurance plus 2 months reserves on that. So is that a closing cost? That's an expense. That's still your money that the bank holds in an escrow account. This happens also for FHA loans and for conventional loans that want to be impounded. With the conventional, you have the choice of not impounding your payments, but FHA and VA require the impound payments. So yeah, that goes towards their closing
So
costs.
even a purchase for like 500,000, you'd want at least $5,000.
Yeah, with these 5,000, yeah, that's acceptable. You got muted again, Danny. But yeah, I got the tail end of what you were saying. So yeah, that's the case with VA. Now, if the seller's paying for everything for the buyer's cost, and the seller could pay for the cost, escrow fees, title fees, lender fees, and reserves, which means the buyer's not bringing anything at all on VA, that's fine. So whatever they have in deposit will be refunded back to the buyer. Okay. And what else with the VA loans? Yeah, basically that's it. Conventional loans, conforming and non-conforming loans. The conventional loan, conforming only means that there are two types of loan limits. Let's say for a single family home, the conforming loan limit is up to 540,000. Above 540,000, it's termed a non-conforming loan. But the newer term for it is high balance loan. What's the difference? The difference is in the rate, maybe about an eighth. So if the loan amount is 540 and below, let's say you're getting a 2.99. If it's above 540,000, then there's going to be an added eighth or a quarter on the rate, depending on the credit score. Okay. Now, conforming conventional loans are following the guidelines of and insured by the Federal National Fannie Mae, Federal National Mortgage Association, and Freddie Mac. These are the two entities that insure and securitize these loans. To give you an idea of what the loan limits are, these are the loan limits for LA and Orange counties. You can see that for a single family home, it's 548,250. And then in excess of that becomes a high balance loan up to 822. So you could see the units go higher, 3 units and 4 units up to 1.581. Unbelievable. I never thought I'd see that, but I guess that's how much our money's worth now with inflation. So looks good. Now, the thing about units and purchasing units, I have to go back to FHA, is that with the 3 and 4 units, FHA is going to see if the property qualifies. They're going to have to do a debt servicing, ratio on the units. So which means the total gross income of all the units times 0.75 will be the net income of those units. And that's 75% of the gross has to equal or be more than the PITI. If the PITI exceeds that net income of these units, then FHA, then the property will not qualify for FHA. Okay, so, and in California, that's very difficult. Most of the time, 3 and 4 units don't qualify for FHA only because of the debt servicing ratio on these units. It does not apply to 2 units. That's only for FHA. As far as conventional loans concerned, when you get into 3 and 4 units, they do require you to put at least 25% down. For 2 units, they require you to put 20% down. There used to be 10% down, but now they're going back up to 20%. Going back up to 20% down. And what is the case? Basically, just give me a call. Let's see where Fannie Mae, Freddie Mac are again. But right now, they're at 20% down minimum if you want to buy 2 units. Okay. Who is Fannie Mae? Again, Fannie Mae is this entity that securitizes and insures the loan for conventional products. Founded in 1938, it's been there for a while. Freddie Mac, the same thing. What's the difference between Fannie Mae and Freddie Mac when they're both conventional loans? Well, one main difference, actually 2. With Freddie Mac, if you have a self-employed borrower who's been in business for at least 5 years or been self-employed for at least 5 years, not a day below 5 years, but 5 years and above, they will only request for 1-year tax returns. Why could that be quite significant? That's because most self-employed borrowers, their income is up and down. It peaks and valleys. And so let's say, for instance, in 2019, that self-employed may have had a negative or maybe just a minimum net income that they showed or declared to the IRS. But then in the year 2020, they made so much, and it shows now in 2020 that they may have netted about 60,000. With Fannie Mae, it is required for us to average out the last 2 years. And so we average out 2019 and 2020, with 2019 being a loser, 2020 being great, it's going to decrease his average income. However, for Freddie Mac, we're going to just ask for that 1 year, the latest tax return, and we're going to go based on the net income on the tax returns. So we're going to use that full $60,000 net. Okay, that's number one. Number two, a lot of buyers now, being that they're younger, have a lot of student loans, most being deferred. If they're being deferred, that means, let's say if they have $200,000 worth of student loans and zero payment because it's deferred, Fannie Mae requires us to put as a debt to them 1%. Was it 1 or 1.5? I think it's 1.5% of what the balance is of the loan as their monthly debt. So that's going to drive up their debt and most probably won't qualify them. And that's why we switched the loan to Freddie Mac, wherein with Freddie Mac, they only will ask for 0.5% of whatever the balance is of that student loan as the monthly debt, and that's what we plug in, which improves their debt to income ratios. As a matter of fact, Freddie Mac, I always try to go Freddie Mac. I don't know why we even have to go Fannie Mae sometimes, but there are some banks that only do Fannie Mae who have pretty good rates, and Freddie Mac with other banks. So depending on who's giving us the better pricing is the loan we want to do. But if Fannie Mae gives us the limitations of getting the loan approved, Freddie Mac's really a great alternative to that. And sometimes, for the most part, rates and pricing are the same between the two banks. Okay, so Freddie Mac's they're a little bit more lenient. And also in terms of reserves, after we close, usually Fannie Mae requires 2 months of PITI reserves in the bank after the borrower brings in the down payment and closing costs. Freddie Mac sometimes does not require the 2 months reserves. Okay, those are the difference between Fannie Mae and Freddie Mac. Any questions so far? Okay, let's see what else I have here. Oops. Non-QM loans. We call them non-QM loans. QM meaning qualified mortgage. So these are the loans that are mainly geared towards the self-employed person that has a very weak income documentation with the tax returns, or those that get paid cash, but own their business, or independent contractors, 1099. When you're 1099, you could be $100,000 1099, and then after declaring all your expenses and all this stuff, then you only net maybe about 20 or 30 or 40,000. With non-QM, we're not going to be asking for tax returns. They do have to have skin in the game, which means they do have to have at least a minimum down of about 20%. Their credit score has to be at least a minimum of about 660 to get a pretty decent rate. Anything below that, they'll have to put bigger down payment. And so all we ask for, let's say, for instance, for the borrower that is looking to purchase their primary residence, is to provide a CPA letter, CPA letter stating that they've been filing as a self-employed for over 2 years, and also a profit and loss statement from their CPA, and showing their actual net. Okay, and so we're going to base it on what the year-to-date profit and loss statement is going to show. That's one way to qualify. For investors who are purchasing rental properties up to 4 units, what we do is we get the debt servicing ratio. In this case, we just go by the gross. So if the PITI, let's say it's 4,000, the gross income for that property has to equal 4,000 or more or better. And that's what is going to determine their down payment. If they have to put an additional 5%, let's say minimum down is 25%, by the way, for the DSCR program, debt service and credit ratio. It has to be at least a minimum of 25%. And if they're not meeting the DSCR ratios, then they'll have to put a little bit more down to bring up to bring down the PITI so that it will be equal or less to what the gross income is for that property. There are a lot of programs out there which are really the box programs, depending again on the scenario of that individual. And it all boils down to what is their credit score, how much down are they putting on the property, and where the property is located and what type of property it is. But yes, the banks are opening up the floodgates right now to provide more out-of-the-box funding for those out-of-the-box buyers. Okay. That pretty much concludes my presentation for today. Any questions so far?
Jonathan, I just want to make a couple of comments. Raise your hand, turn your camera on, or use the chat if you got any questions. But one of the advantages of using a mortgage rep, and especially Jonathan in particular, is when you have a client that has problems. Typically, if you were to go to most lenders and you've got a really low FICO score, or they've had credit problems, they're just going to say no and they're going to deny the file. But the story I always like to bring up is that I think it was both of our longest escrow that we had, and the background on this was the seller was renting to a tenant that used to be his employee, and I think the tenant had been there for 10 years, and he wanted to sell the property at market to the tenant, and he was willing to wait to get them to purchase it. The problem is it was a couple. I think they just had one kid, but their FICO score was like 500s or low 500s, or I mean, it was like really bad. And the seller wanted to cash out, so I think it was an FHA loan. But Jonathan was able to massage their credits. He had to work on both of their credit reports. And was it 2 years or a year and a half, or?
It was going on 2, right?
Yeah.
Closer to 2 years and then yes.
Yeah. So fortunately for the buyers or the tenants, is that the seller kept that price. So the buyers end up getting a really good deal because they were renting, and I think they were only paying like $700. This is a condo in Gardena. They were only paying like $700 a month. So there wasn't much motivation for the tenants to hurry anything along because their payment was going to be closer to $2,000. But Jonathan was able, I think he got him up over 700, FICO over 700.
Yeah, 750, somewhere about. That was really high.
Yeah, yeah. So that's what's amazing work that Jonathan can do when you have a problem client like that. But don't just send him your problem clients either. But he can get it done.
And just as good with great loans.
Yeah. Yeah. Any other questions or comments out there?
Yeah. One more thing. We are closing tremendously fast right now with purchases. Okay, so it all depends again on the file of the borrower. If your borrower is on top of the files, great FICOs, good down payment, even up to 5% down. I've got one clear to close in 8 days, another one clear to close in 12 days, and another, they can't keep up, and we close in normal 30-day escrow, a little bit sooner. I have one, I think one of your agents, I'm sorry, name slips my mind right now, came to me from another lender. They were in a time crunch. We were able to get that in and close sooner than they expected even. So in case you might be in that position, please reach out to me, or if you want to prep up your clients to make sure that they are totally qualified, get a loan commitment, and be totally prepared to go out there and swim with the sharks. Let's get them prepared, and you got my number. You know how to get in touch.
Thank you, John. And for those buyers that are cooperating and give you the paperwork back right away as far as tax returns and stuff that you ask for, how long does it take to get a direct underwriter approval on a buyer?
Well, as long as I have a pretty good idea of what it is, I could actually do it immediately. If they give it to me, it takes within 24 hours for me to get that direct underwriting approval. Of
Oh,
course,
wow. Okay, that's excellent.
file. Right. So I could only be as fast or as slow as depending on the borrower's space.
Yeah.
Yeah.
All right. Any other comments? Thank you. Thanks, Jonathan. Thanks for joining us.
All
Talk
right,
to you
guys.
soon.
Have a great day.
All right.
Thank you,
Bye-bye.
Jonathan.
You're welcome.
Thank you.
Thank you.